Behind the scenes, how insurance policies, rates, and laws come together. Let's start with who helps shape the policies and rates we see in insurance. Insurance Service Office is also known as ISO. ISO is an advisory organization responsible for developing standard policy forms, coverages, structure, provisions, agreements, clauses, deductibles, definitions, conditions, exclusions, endorsements, and other conventions for use by the insurance industry. ISO standards and forms are the most common found in use throughout the industry. They're the ones who create many of the standard policy forms and coverage options used by most insurance companies. Basically, they help keep things consistent across the industry. The American Association of Insurance Services, AAS, does something similar. ASA is an organization responsible for collecting statistical data, distributing rating information, developing standard policy forms, and filing information with state regulators on behalf of insurers that purchase its services. SFAA is a trade association working with all segments of the surety and fidelity bonding industry, acting as a resource to promote and maintain outreach to the public as well as industry and government regulators. In summary, SFAA focuses on the bonding side of insurance. They work with regulators, industry groups, and the public to make sure everything runs smoothly in the surety and fidelity space. Then there's the National Council on Compensation Insurance, NCCI. They handle workers' compensation. NCCI provides data, statistics, solutions, and analysis to help insurers set fair rates and manage risks effectively. Now it's time to look at the federal regulation laws. A few federal laws also shape how insurance companies operate, especially around privacy, communication, and ethics. Let's look more at each one individually. The Gramm-Leach-Bliley, GLB, Act of 1999, or the Financial Modernization Act, focuses on protecting consumer privacy. It says that financial institutions, like banks and insurers, have to tell customers how their personal information is shared and what their privacy rights are. The Fair Credit Reporting Act, FCRA, is all about keeping consumer credit information accurate and private. The FCRA places the following responsibilities upon companies that use credit information. Users can only obtain consumer reports for permissible purposes under the FCRA. Users must notify the consumer when an adverse action is taken on the basis of such reports, such as a higher insurance rate. Users must also identify the company that provided the report so that the accuracy and completeness of the report may be verified or contested by the consumer. Because insurers also provide information back to credit reporting agencies, they must also provide complete and accurate information to the credit reporting agencies. They must also investigate consumer disputes received from credit reporting agencies. In addition, the FCRA regulation says users must correct, delete, or verify information within 30 days of receipt of a dispute. Don't forget the FCRA regulation says users must inform consumers about negative information which is in the process of or has already been placed on a consumer's credit report within 1 month. Here's what it means in practice. Companies can only pull credit reports for approved reasons. If a decision, like raising your insurance rate, is based on your credit report, you must be told. The company also has to tell you which credit agency provided the report so you can dispute or correct any errors. Because insurers also send data back to credit agencies, they're required to report accurate info, fix mistakes quickly, and let consumers know if negative information is added to their report. The Telemarketing Sales Rule, created by the FTC, sets the ground rules for telemarketing. It says telemarketers have to be honest, can only call at certain times, can't call people who've asked not to be called, and have to follow payment and disclosure rules. The Controlling the Assault of Non-Solicited Pornography and Marketing, CAN-SPAM, Act of 2003 established the United States' first national standards for the sending of commercial emails. The most relevant section of the law involves rules surrounding the sending behavior of a company that sends a commercial email. A message cannot be sent without an unsubscribe option. The unsubscribe button should be at the bottom of the message. A message cannot contain a false header and must have at least one sentence. That means the message cannot be null. To sum it up, the CAN-SPAM Act of 2003 deals with commercial emails. It requires that companies include a clear unsubscribe link, use real and accurate headers, and make sure every message actually contains valid content, not just spam or blank emails. The Terrorism Risk Insurance Act, TRIA, was initially enacted as a temporary 3-year program to calm insurance markets through the creation of a government reinsurance program that would share in terrorism-related losses. The TRIA will pay certain claims in the event of a loss due to a certified act of terrorism. So it helps insurers cover certain terrorism-related losses so the burden doesn't fall entirely on one company. And finally, the Violent Crime Control and Law Enforcement Act of 1994 says that anyone convicted of crimes involving dishonesty or breach of trust can't work in the insurance industry. Well, that's the end of your behind the scenes, how insurance policies, rates, and laws come together. Congrats on finishing another video. Make sure to check out the next video to learn more about property and causality insurance.